All right. How to sell a top, get shook out, not get back in. It happens. Sometimes, not sometimes. If you the more you trade, the more of a little bit of everything's going to happen to you again and again and again. But we had a place that could be a top up here, 20 to 22 up here. Got it? What I look for is number one, we're going to get down into the weeds here. You see this red iceberg? Generally, if it pops up through it and crosses back south of it, that's bearish. I get in too early. Hit a little head start, but then got myself stopped out on this pullback. It was pretty much a scratch, and I got out and saved taking this extra heat. However, then the market gives me a better get the hell in step 3 moment, and I don't put them back out there, and then end up being a good the better trade. But I get shook out a little bit, and I'm saying this because that's what markets do, right? A job of a market is to test you and shake you out. It's just like if you're a parent of small kids and when they're aggravating you and you step back and say, you know what, that's their job, to aggravate you and push you, see where your limits are. Your job is to set limits and boundaries and stick with them. So it makes you feel a little bit less mad at them because their job is to push you. They're curious. What can I get away with? So it just makes you a little bit more, not, I don't say patient, but just understandable that it's not personal. It gets personal when they probably become teenagers. But either way, you look at this and you say to yourself, it went green and then back to red on the laser. And guys in the room know what I'm talking about this because we just went over it. But right here, it goes red to green. So everything is working out right below the this red iceberg. Got it? And then it goes green. I anticipate that's getting even a little bit better than when it turned green. And so I'm sitting there. Once it goes red, I get out before this 243 lot buyer comes in. This is something I don't want to take forever to work when you're fading a strong move up. So then this shakes out other shorts too. And when you have less shorts, and I was one of them, you have less buyers below. What do you think I did with my resting buy order below once I covered my short right there? I canceled it. It went away. So if buy orders are going away, it's easier to go down. That's why you got to shake people out of positions. That's why it's the market's job. Shake out weak hands. I was weak, and that's fine. Longer you trade, more examples of everything are going to happen to you. So let's play this. What am I looking for? So what I want to show you is this red kind of gets shaven back, and bigger long positions come in, which is a very good ingredient for the pasta to turn out right. You want different ingredients to make the gravy turn out right, or the lasagna to taste right. Well, this is the ingredients to make a top. All this. What's all this? These are sample size of longs. These are longs trying to exit. And generally, that is what you want to see and almost need to see for a top to be a top. It's temporary. It doesn't, people say, that was the high of the day. No, I know that. You're not trading to pick the highs and the lows. You're doing temporary highs and lows. So, and I even pointed out how I missed it and was missing it, but it goes straight down pretty much. This red made it sideways a little bit. When it went back green, I stepped on it. So that was a kind of a good lesson of why markets do what they do, how you become part of a head fake, and how you helped if you were short by getting kind of knocked out, how you helped facilitate that. Let me walk you through the analogy of a boat. If there were a lot of people on the boat and let's say every one of these stick figures represent 50 people, and the boat started to sink. Okay, started to sink. Someone yelled out, "If we throw 100 people off the boat, the rest of us will survive." Well, they're going to overcompensate, probably throw 150 people off. So there'll be a big skirmish. People go overboard. Even some strong hands will go overboard. They had a bad location. They were sitting on the rail. They got pushed over. So now they're down to 75. They overcompensated. They threw out, there was 200 people. They threw off 125. And then they said, stop, 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 stop. And the boat started to float. So they had to adjust, correct, shake out the weak hands. So let's just talk about this analogy making sense on the downside. Think about this a second. When the market price is going lower, okay, what do you need for it to start to float and rally again? Do you want a lot of shorts? No, because shorts are buyers. No, I'm sorry. Do you want a lot of longs? Like because they're anticipating this? And the answer is no, because longs are sellers. If you convince yourself that longs become sellers after they're long and shorts become buyers after they're short, do you want a lot of longs? A lot of people initially would say, yeah. No, that's the people on the boat. You want to shake off those longs because the sellers, when there's a lot of them, prevent price from going up. Everybody knows the answer to this question if you think about it. For price to go up, you want more buyers and less sellers. Everybody, after thinking about it, would agree. Yes, that's what I want for price to go up. The dynamic of more buyers and less sellers. Well, if I have too many longs, I have too many sellers. That doesn't fit my dynamic for price to go up. That's the too many people on the boat. So you have to shake out the longs. And sometimes the price pattern for that looks like, where it's chopped. Yeah, shake out the longs, it goes down and then it rallies. And it's like, it had to stop me out before it went up. And the answer is yeah. You were long with too much other competition, too many longs, too many sellers, price can't go up. So what does it have to do? It has to throw you off the side of the boat in order for the boat to do what it wants to do or can do, and that's float. In this case, for price to do what it wants to do, and that's rally. It needs to get there. Get where? It needs to get to where you have less sellers and more buyers. Remember that. And that's the dynamic and the answer to the tests that drives every price. Order flow through the intent of what they're using the orders for, and that is to open up positions. If you know the intent of, if you got the inside track at a car dealership and you got the intent of the dealership buying all this new supply in cars, and you know that they overbought and they're stuck, and now you got what? Stuck sellers. You got stuck sellers, and you can come in, and then you also have the inside track that you didn't have as many buyers that month, and you got stuck inventory. So good time to negotiate because you got less buyers, more sellers with the more cars that are on the lot. So I think that I can never say this enough, teach this enough with respect to why price moves. It's the biggest difference between what I'm told, me, and everybody else. So I don't think I could ever explain that enough. More buyers, less sellers, more buyers, less sellers. And that's what makes price go up. Now our job is to, how do we get there? How do we get there? And you just you got to break it down to buyers and sellers. How do you get buyers? Well, I know after you're short, you're a buyer, and after you're long, you're a seller, right? So, you're building up to it, right? So if you get a lot of shorts, they could be stuck, and if they're stuck shorts, that means they're buying that's coming. Another thing to also remember is why price moves up, not because people buy it, but because people want to buy it, they can't get filled. If people are buying it, then they're satisfied with sellers and they're exchanging a satisfactory price. The price discovery process is saying, hey, we've got buyers and sellers that are agreeing at this price. let's chop sideways. But when you get buyers that come in and say, hey, I'll buy it at 21 even, and it's quiet, how about 22? It's quiet. 23, 23 quarter, 23. Buyers who are willing to buy but can't get filled is what price goes, why price goes up. Sellers willing to sell and can't get filled, is why price goes down. So a lot of people would get that wrong and say, why does price go up? Yeah, it's buying that's getting filled, but certainly more so that buyers who are not getting filled. What's the analogy I use? 3 people bid on a house, price goes up, only 1 person got filled, but the other 2 were instrumental in the direction of the price of that house. Buyers who cannot get filled is why price goes up. Not that they're getting filled, because when they're getting filled, you got the discovery process. You want to see miss overall. And that's the only reason why price goes up and goes down. So if you're going to trade price, and which means you're trying to predict where it's going, you better know why it goes. Or you're like a meteorologist who doesn't know why it rains and they're trying to tell you if it's going to rain tomorrow.